Hello, everybody. Very pleased that you're all here. We've got an absolutely first-class turnout tonight. It's wonderful to see the amount of support this event's gathered, which is a tribute to the people who have been involved in promoting it, the people at the Mortgage Prisoners Group, who you'll be hearing from later on today. We are genuinely quite excited about the fact that we've got well over 100 people who've booked onto this event, and frankly, the numbers just keep going up and up and up. In fact, I was talking to some of my colleagues earlier today about the idea that we at the Transparency Task Force would be very happy to run a follow-up event to this in about 3 months' time, because we think this is an ongoing story. It's a bit of a saga. It's seemingly never-ending, but everything we can do to help shine a bright light on what's been going on, we do want to do that. So thank you all very, very much indeed for being a part of this session. Please don't think of it just as being some kind of an event or a symposium that you go to, listen to, and that's it. That this event has a purpose, and the purpose of this event is to galvanize support for the idea that the financial services industry and the banking sector, and frankly the government, haven't yet looked after mortgage prisoners the way that they ought to be looked after. We at the Transparency Task Force, and I'll explain a bit more about the Transparency Task Force in a moment, but we at the Transparency Task Force believe that mortgage prisoners have been treated in a grotesquely unfair way. I'm going to repeat that. We at the Transparency Task Force believe that mortgage prisoners have been treated in a grotesquely unfair way, and that needs to change. There most certainly have been various disappointments along the way, and it's really quite surprising that even now, years after the event, it hasn't yet been possible for mortgage prisoners to get the justice that they deserve. We're going to do all that we can to try to make a bit of a difference, and you never know, the small bit of difference we're going to try to make might make the big difference that everybody wants to achieve. And there's no harm in trying, and there's no shame in giving it our best, and that's exactly what we're going to do. So I'm going to introduce myself and the Transparency Task Force. My colleague Alexandra Zitkus, who's put a lot of work into this event, our head of events, is going to deal with a few housekeeping notes. I'll then say a few more words. We're going to be then listening to and watching a video statement from Martin Lewis, the money saving expert. I'll then be passing over to Rachel Neal. We'll then be hearing from Kevin Hollinrake MP and Seema Malhotra MP, then from Professor Sharon Collard, then from Olivia Sully and Edward Argles of Harkers Parker, the law firm involved. We'll then be hearing from Kat McShane, who helped produce the Trapped by My Mortgage programme. And then we'll be hearing from Andrew Montlake, MD at Corco and host of the Property Show podcast. There'll be ample opportunity, we hope, for Q&A and discussion. Because there are so many people on the session tonight, it would be perfectly sensible, if you have any questions, please type them into the chat so that we can draw from those questions, and we'll also get some dialogue going on after the event as well. But what I'm going to do now is introduce myself and the Transparency Task Force. So I'm Andy Agathangelo. I'm the founder of the Transparency Task Force, or the TTF. We're a rather unusual organisation. We are in fact a certified social enterprise, which very simply means that we are committed to trying to make an impact. We're not about making money, we're about making an impact. We operate as a not-for-profit. Our organisation is essentially an international community made up of over 3,500 people around the world who share our view that the financial services industry is profoundly important to the well-being of society. We want the financial industry to be reformed. We want it to do a better job of protecting consumers from harm. We want to build an international institution that is dedicated to making sure that consumers from the financial services sector are actually being treated in a fair and appropriate way. So that's what we're all about. In organizational terms, we operate through groups. So let me share with you what I mean by our groups. We have 25 groups. I'm scrolling through some of them now. Regulators Watch, investments. We have groups covering foreign exchange and payments. We have groups covering banks and building societies. Each one of these groups is a mini campaign engine in its own right. Every single one of our groups is doing something to try to help reform the way that the financial system works. And some of them are particularly relevant to the session that we have this evening. This evening's session, from our point of view, is an output of our debt group. Our debt group is focused on topics such as obviously the mortgage prisoners issue, the issue around the very big issue around the pay now, borrow now, pay later issue, and so on and so forth. There really are a lot of things that we are very busily focused on. I'll also share with you the fact that we run 2 all-party parliamentary groups. When I say run, we are the secretariat, the secretariat to them. There's an all-party parliamentary group on pension scams. That's a topic we've been working on for about 5 years. The key highlights here are the fact that we helped to get an inquiry opened about the pension scams problem. That was last year. The inquiry was carried out by the Work and Pensions Select Committee that is chaired by, the chair of whom is Stephen Timms MP. And the second all-party parliamentary group I'll mention is the all-party parliamentary group on personal banking and fairer financial services. The reason we help to run these APPGs is because we have a very clearly defined strategy for driving change. And that strategy for driving change is all about the idea of bringing together the thinking of 2 groups of people. On one hand, those who have a sense of passion and purpose about the change that we want to see, people like myself, people like Rachel, who you'll be hearing from later. All the people in our community are passionate about the need for change within the financial services sector. The other group of people who are also very important, of course, are those who have the power and the position to make change possible. And that really is a very, very important group. Within that, of course, we mean the politicians, the policymakers, the regulators, and so on. So the Transparency Task Force strategy for driving change is frankly to try to influence the thinking of the people who can make a difference. So the way that we work and the way that the Mortgage Prisoners Group works is very much aligned. I'm also going to take a moment to tell you about this. This is a United States database called Violation Tracker. The reason it's relevant is because of what you can do with it. So it's a database that captures information about organizations that have broken the rules. And one of the things you can do with it, if you click on industry totals, if you can see that there, click on industry totals, it gives you a breakdown of the infringements by different industries, with the worst offending industry at the top. Isn't it interesting, ladies and gentlemen, that the financial services industry, an industry that I would argue should be the most trusted and respected industry of all, is actually the worst offending industry, ranked by infringements against US authorities. The reason I say should be the most trusted is because the entire financial system is based on the idea that it's trustworthy. The word credit comes from the Latin word credere, which means believe in. And I'm making this point, folks, because we need a financial system that everybody can believe in, that everybody can trust. If you take trust out of financial services, you really have very, very little left. And that's why the experience of the mortgage prisoners is so significant. So you just think about the amount of trust it has destroyed within the financial services sector. And you think about the consequences of the 6,166 infringements against US authorities, totaling a staggering and eye-watering 331 billion, not million, 331 billion, 558,339,161 dollars worth of penalties against the financial services industry in the USA. In fact, it's so large that if you add up all the other infringements of all the other industries, here's pharmaceuticals in second place, here's oil and gas in third, here's motor vehicles in fourth. If you add up all of the other industries together, they just about equate to the financial services sector. And here's the problem. The problem is, ladies and gentlemen, the data is telling us, the proof is there to be seen with your own eyes. There is something particularly strange about the behavior within the financial services sector, and that we think is one of the underlying causes behind what's been happening with the mortgage prisoners saga. Interestingly, if you then click onto the financial services sector, you get a breakdown of the worst 10 offending banks. And by the way, here's Royal Bank of Scotland, a British bank, being included in a top 10 against US authorities. And you then have the individual cases. And what you find when you look at this data in detail is you find a pattern. And the pattern is the same organizations and the same parent organizations are being caught doing the same sort of things over and over again. Look at the sorts of things they're doing: toxic securities abuses, banking violations, insider trading, anti-money laundering deficiencies, price fixing, etc., etc., etc. And the real worry that we have within the Transparency Task Force is that we think there's evidence here suggesting that banks in particular are susceptible to thinking of being caught doing something wrong as simply a cost of doing business. And if that is right, ladies and gentlemen, it's a real worry, because that would point to major cultural, structural flaws in the system. These are the sorts of things we worry about. Now, you've heard me make a few references to the fact that this is a United States database. It is, but I'm very pleased to tell you that over the last year, we've worked pretty hard to try to bring this to the UK. So I'll put a note in the chat in a moment that will share with you this press release explaining that Violation Tracker is coming to the UK, and it will help us to frankly publicise the kind of malpractice, malfeasance, misconduct and mis-selling that has been going on over a long period of time that really does need to change. I'm going to invite my colleague Alexandra Zitkus, our head of events, to say a few words, and then I'll be showing you the video statement from Martin Lewis, the money saving expert. Alexandra, thank you. Over to you.
Evening, everyone. Thank you for being here. Just a few things to let you know that, first of all, we are recording this event and it will be uploaded to our YouTube channel, TTFTV, sorry, in the next few days. So I'll obviously send you an email when it's up. Also, as I can see, some people have already started using the chat, so please do use the chat to make any comments, ask any questions, or introduce yourself. I'll circulate all the notes put in the chat in a follow-up email tomorrow. And also, if you use Twitter, please feel free to tweet during the event. I'll put our Twitter handle in there and some hashtags that you can use. So, and that's it from me. Thank you.
Fantastic. Thank you very much indeed, Alexandra. Now, we have so many people this evening. It really is going to be most practical if we invite people to use the chat to make points and ask comments and make comments and ask questions, etc. I'm now going to show that video statement from Martin Lewis, which is well worth watching. I know he's been highly supportive over a long period of time around this particular cause. So let me go to that now. So here we go.
Martin Lewis from moneysavingexpert.com. I'm so sorry I can't be live tonight. My schedule is extremely hectic at the moment. Now, look, I know many of you will be very disappointed about what happened recently. The vote in the Lords for an amendment to cap the SVR for mortgage prisoners was fantastic, and it was great awareness raising, and it's something that we can certainly use going forward. But I know you'd be gutted that the government turned it down. I think it's probably worth me being honest that what I always expected would happen, and I hadn't held out as strong a hopes as some others did. about the SVR cap being accepted. There's a number of reasons for that. The first is the LSE report that I funded said it was a rather blunt tool. As you'll know, I was very deliberately publicly supported it, saying it was a great stopgap measure. But what you have to remember is that LSE report was written based on the terms of reference. Effectively, the government set out saying what it wanted and what it did not want in order to be able to help mortgage prisoners. And that was not one of the good fits. But I don't think that having been through that, while there's a short-term disappointment, it means this is the end of the road. In some ways, what we now have is a commitment from them and some of the MPs, even though they turned around and didn't vote for it in the end, Conservative MPs, to actually looking at the mortgage prisoner issue. As you'll know, many of you, in my budget show, I specifically put this point to the Chancellor, and he gave a promise that something needs to be done. It's a politician's promise, but it's something. This is about raising awareness, upping the temperature of them doing something. And Will and the Money Saving Expert Campaigns team are working very hard at the moment to try and push the government into giving us the data we need to go further with the LSE report. And I'm committed that if we can get there, I'll fund more work on that myself. So look, the options are still open. It's a big push at the moment with the pandemic going on. It's difficult to get attention on anything, certainly a big issue like this. And there are many other competing groups who are struggling for income, those who are excluded, those on the loan charge, and others cladding, all of whom are pushing government. Very difficult to raise your head above the parapet and to get an issue noticed, which is why what happened in the Lords and the debate that happened there and the awareness raising on MPs is really important for continuing to push on this. I know it's all very easy for me to say because I'm not sitting in the nightmare position that many of you are. And this is not going to be quick. Do not expect this to be happening in weeks or months. It's just not going to be quick. But the fight isn't over and the door isn't closed. You know, there is potential for things to be turned around here. So please do not give up hope. And while I'm not in the same position as you, I am committed to doing all we can on this. This is MSE's, on the campaigning team who work for MSE, this is the #1 priority, is mortgage prisoners. #1. It's something that I've put myself aside on in terms of I'm going to keep going on this as much as we possibly can. It's no guarantee of success. There never are in this. But we've certainly, you know, all of us collectively, especially the powerful voices and advocates that you have got this issue on the agenda. And that is something that many campaigns involved in don't even get that far. So we'll keep going. I hope you have a great talk going forward. Do not give up hope. There are other options out there. We have to keep pushing, although I doubt it'll be that quick.
Okay, fantastic. Great to hear that level of support and commitment from Martin Lewis, the money saving expert. It's obviously very, very genuine. He's been supporting your cause for a long time, and it looks like he's committed to carry on doing that, which really is marvelous. One of the kind of views that the Transparency Task Force has is that we are all definitely much better off working together collaboratively to try to make change happen. The approach that we try to take is to be collegiate, cooperative, collaborative. That's the approach that's helped us get a few victories over the last 5 or 6 years, getting inquiries opened and that kind of thing. So it's with that spirit of cooperation and collaboration with politicians, with policymakers, with regulators, with these sorts of organizations and individuals that have the power and the position to make a difference. It's with that spirit that the TTF has developed. Through it, we've actually been able to make a real difference. So therefore, of course, what we're looking for this evening is an event, a symposium where we can unite our energies, focus on the task at hand, find ways of working collaboratively. We won't always agree with everybody about everything, but let's find what the common ground is and let's make sure we do all we can to harness the goodwill and intention from everybody that's happy to help in some way. Politicians, policymakers, regulators, campaign organizations, and everything and anybody else. Okay, I'm going to invite now Rachel to pick up from here. It's been an absolute pleasure to get to know Rachel and her colleagues over the last few weeks. It's been a real pleasure to collaborate, and we're very pleased we found a way to work together by putting this event on to try to galvanise support for the cause. So Rachel, thank you very much for being here. Over to you. Thank you.
Thank you, Andy. So thank you everyone for joining us tonight, and to those that have agreed to speak, and thanks to Martin Lewis and the MSE team for the pre-recorded statement. As some of you know, the mortgage prisoner issue has spanned now over 2 decades, and I believe it is one of the biggest scandals towards homeowners, which until recently many knew very little about. The mortgage prisoner issue began around the 2008 financial crash due to the government's handling of the bailout of the banks. Overnight, hundreds and thousands of homeowners went from being a customer of a top high street mortgage lender to an inactive, non-lending mortgage book administrator. Over the many years, I'd always felt, like many other mortgage prisoners, that I was the only one, and without the BBC Panorama programme, I would still be sat here feeling very lonely and desperate over the whole situation. In 2018, I was approached by Kat McShane, who was researching for the BBC documentary. It was then I realised I was not alone. I'd been trapped in a situation affecting thousands of families, and yet no one knew. After Panorama aired, I discovered the effects suffered by others who had also been trapped. The floodgates opened and hundreds of people contacted me to tell me they were in the same situation. From this, UK Mortgage Prisoners was born. The Facebook group grew from 40 people to now over 4,400 members. Since then, and as a group, we've been campaigning for fair treatment for all mortgage prisoners, despite the 13 years of the mortgage prisoner issue and over 2 years of relentless campaigning. We still receive large resistance for help from the government. Despite numerous voices agreeing that the mortgage prisoner scandal was created by the government and so should be resolved by them too. We've gained enormous support through debates in both the Commons and the Lords, and the majority are now aware of mortgage prisoners and the detriment experienced by families through no fault of their own. I strongly believe we have a huge opportunity with this new gained support to apply the necessary pressure for an urgent solution and make a real impact to change the future lives of mortgage prisoners. I believe government have an opportunity to help all mortgage prisoners to create a fair system for us to exit onto, through a government-backed mortgage guarantee scheme. It must see all mortgage prisoners helped despite the status of arrears, negative equity or affordability testing. Mortgage prisoners have become trapped in a situation that we neither consented to nor asked to be put in. We are now living in a crisis within a crisis. Most have continued payments on extremely high rates for many years, but have been tarnished as bad borrowers. We are victims of circumstances beyond our control that we never chose. We are victims of the government's greed to make as much money as possible from the Treasury from the sales of our mortgages. And our campaign will see us strongly push for this scheme to be put in place by the Treasury to ensure the misery ends. A government-backed scheme will ensure that we are given the same opportunity as those in the active market and would put us back to where we began on a fair playing field. We see the desperate situation many on the group and beyond are facing and read the stories every day that is impacting families' lives. I am also well aware what a huge disappointment the recent rejection to the cap the SVR created. We know how difficult each month is for so many. Due to the Treasury and John Glenn now wanting to do a further review, we feel it is neither needed or necessary. We are writing to the Treasury and the FCA to request a moratorium to pause all repossessions for mortgage prisoners. Whilst this review takes place and without creating further impact on our lives, this would be fair in view of being asked to wait until at least November. These were mortgage books that were sold for profit. In doing so, we were treated as an asset. We should have been given protections. Our home should be a place to thrive and be a secure home for a family. Instead, it is a place of stress and resentment for so many due to our destiny being removed by the government that were there because we trusted them to make the right decision, and they failed. Lastly, I would like to very briefly give you an outline of a new initiative we are looking to pilot with local authorities and stakeholders called HOPE. HOPE stands for Home Ownership Protection Enterprise, to prevent homeowners being made homeless through repossession. There are many schemes that protect renters, but none that protect those with mortgages and homeowners facing difficult times or holding on to their homes whilst being a mortgage prisoner on high rates. A homeowner can find themselves in this position due to impacting situations that only encroach the situation further. For example, an illness that has impacted on your income, therefore unable to make mortgage payments, or losing the SMI benefit as it is now moved to a loan. The SMI loan is effectively a second charge on your property, which creates another obstacle for homeowners to overcome when trying to remortgage. This has caused many needing to find additional hundreds of pounds a month. These are just a couple of scenarios that can happen over a lifetime of a mortgage. Renters are protected and helped through the safety net of their local authority and being able to claim help. There is currently far less help for homeowners. We will be looking to run a pilot scheme working with local authorities, the customer, the bank, and the courts if needed, to find solutions to prevent a repossession and enabling a relationship to become positive again between customer and the lender. We feel this will create a solid homelessness prevention scheme for all and hope to engage with all stakeholders. And please let me finally ask all of you to continue to support mortgage prisoners to help end the devastating situation, which I'm sure you will all agree has gone on unresolved for long enough. Thank you.
Rachel, thank you. I've made this point to you privately. You're an absolute natural campaigner. Your sense of integrity and credibility really does shine, Rachel. And I think you and your colleagues are doing an absolutely first-class job. Can we please show our appreciation to Rachel and her colleagues for what they've been doing to date? It really has been absolutely outstanding. Absolutely outstanding. Very, very, very well done to you. And my colleague Alexandra is going to put a document into the chat that Rachel was making reference to just now. And this document's important because it's one thing talking about a problem, but it's another thing actually having a focus about what to do about it. And Rachel and her colleagues have set out a very clear 4-point plan. Number 4, please donate. That's very, very important. Give them the support that you can, whatever that might be, to help them carry on doing the campaigning that they have been doing. But there are some great ideas there. The HOPE idea is fantastic. The idea about putting a moratorium on repossessions, what a first-class idea. We want to campaign with Mortgage Prisoners UK to really help support that initiative, because it just seems the right thing to do. You know, until everything's sorted out, why don't we give the homeowner, the family, the benefit of the doubt, stop them being repossessed until justice can come to the surface. So thank you very much, Rachel. Alexandra has put the document into the chat. We will be following up with emails later, and let's turn this event into another campaign initiative to try to support what's going on. Okay, I'm now going to invite Kevin Hollinrake to spend some time talking to us. Kevin's a great friend and ally, if you like, of the Transparency Task Force. He's spoken at many, many of our events, and he's been wonderfully supportive, not just in relation to TTF's work, but outside as well. So Kevin, really pleased once again to have you with us. You know that our message is very much one of working collaboratively and in a collegiate manner, in a let's all work together manner, and you're a very good example of how that should be done. So Kevin, extremely pleased to have you with us. Please do take the opportunity to share your thoughts about the mortgage prisoners scandal. Thank you.
Well, thanks for the opportunity. And again, I concur with everything you said about Rachel, a fantastic campaigner. And she's absolutely right what she said, in that this is there's market failure here. Effectively, we have in a situation where there is no market for mortgage prisoners in terms of their mortgages, which is can only be defined as market failure, and it is a situation that has been brought about by what the government's done. And I think there's certainly a significant injustice here, and therefore it's incumbent upon the government to solve this problem. A number of reasons why this happened, of course. Initially, prior to 2008, as we saw in lots of other areas of our financial services sector, it was poor and lax regulations led to an overlending in some areas for SMEs and for other borrowers. That, of course, came to a pretty sticky end for the likes of Northern Rock and Bradford and Bingley, who were pretty much borrowing very short but lending long, which isn't a very clever idea when you think about it. And when the music starts playing, you're in a mess, a total mess. And therefore, those banks went bust. You remember the queues outside Northern Rock. So basically, the government had to step in and bail those organisations out. They became entities owned by the state effectively. So the Treasury put a lot of money in, not just in Northern Rock, of course. I think pretty much the same happened with RBS, particularly and Lloyds, in terms of their overlending and their liquidity in terms of SMEs. So, and as a result, there was a couple of agencies set up to handle this. On the SME side, we saw the Asset Protection Agency to manage something called the Asset Protection Scheme, which and then provided liquidity to SMEs. And we saw some abuses of SMEs that really did result from the fact that the Treasury did want its money back really quickly. And I think, I'm not sure I would agree entirely with Rachel about greed, but I think the Treasury has a view that once it's money it does put into the system to intervene in the marketplace, it wants back as quickly as it can. I think that's pretty short-term thinking. And the reason we're still talking about some of the SME abuses and mortgage prisoner problem, 14 years later, is an example of that. So, and the other side is UK Asset Resolution, which then took the mortgage books effective from Northern Rock and Bradford and Bingley, and then sought to dispose of those in different ways. Some of which he sold to active lenders, some of which he sold to inactive lenders. So the problem really was created at that point in time. At the same time, the other thing that happened, of course, is because there'd been an overlending, and I think widely accepted that access to credit had been too free, too easy. So they changed, the FCA then decided to change the affordability rules, which meant you couldn't borrow as much in the future, which is a sensible idea, of course, trying to make sure that the housing market doesn't get over the top in terms of its activity levels. So in 2013 then, of course, these new rules were brought in. But what the government did, of course, or the FCA did, it saw there would be a problem with the new affordability rules by saying, well, if you already borrowed that money, you wouldn't be able to qualify for the new affordability rules, and you might be a perfectly bona fide borrower. Those people would be exempt from the new affordability rules. So if you had borrowed more than was deemed wise with the new rules, you could still access rates with your existing lender if it was an active lender. So the affordability rules didn't apply for you as long as you weren't in arrears. So, but what they did, of course, is that's if you're with an active lender. At the same time, of course, UK Asset Resolution then sold some of these mortgage books to inactive lenders. Inactive lenders who don't have new products, and that's where mortgage prisons have arisen. So, despite the fact that many people in this court, about 50,000 people are mortgage prisoners who are in this situation where they don't meet the credit appetites of lenders, but they are not in arrears, they cannot get access to a mortgage. And there are 70,000 people, of course, 70,000 households who are in arrears, and maybe well be in arrears because of the fact they've had high mortgage payments because the SVR has been too high, but the rates have been too high. So a desperately unfair situation. And this all, of course, is lots of state aid rules around this were referenced by the FCA, and the government looked at this in terms of what they could do in terms of rate setting. And quoting state aid, EU state aid rules, but not to really take into account the fact that the UK is absolutely unique in terms of how it borrows and mortgages, because we keep swapping from fixed rate to fixed rate. If we're all on SVRs, this wouldn't be a problem because SVRs would be lower. But we're not. Most of us on fixed rates. So if you're on SVR, you're probably on a bad deal to start with. So it means that whereas the average UK borrower is borrowing at something like 2.6% mainly through fixed rates, people in mortgage prisons are typically paying about 4.5%, and some much higher than that, or some up to 6%. And this is the situation is even more unfair when these books were sold on to inactive lenders. The UK Asset Resolution did try and get some guarantees that borrowers who were sold to those inactive lenders would get access to new deals. And I think it probably at one point sold them in good faith to those inactive lenders. In fact, when John McFall was chair of the Treasury Select Committee, he looked into this and he was given reassurances by UK Asset Resolution, but which later turned out not to be the case, and the inactive lenders won't provide these access to these new deals. So really unfair situation all around. The government's definitely contributed to that situation. We need desperately to find a solution. There's been some great advocates for this on either side of the House, and pay testament to Seema's work on this, and John Sharkey, Lord Sharkey, who led the charge in the Lords for this and pointed out the real injustices here. So SVR cap, why didn't that go through? I think that's the big question, because that was a solution that came from discussions between the APPT on mortgage prisoners, which I sit, and we had some discussions and said this was pretty much a nuclear option to step in and limit a marketplace like this. But the situation is so unfair, and we have done something similar, of course, in terms of capping energy costs with capping standard variable rates for energy. So there was a precedent for this, and there's no doubt in my view this is much more gratuitous example of unfairness in the system, because at least in the energy market you could have switched, whereas mortgage prisoners, whatever their capability, simply cannot switch. So why didn't it go through? Well, clearly it was never going to go through is the answer to it. So I know some people were disappointed that I didn't vote for the amendment, but it would have been a kind of it would have been a token measure for me to vote for this amendment, because clearly there is a big majority in the Commons. The Lords have a majority, the opposition have a majority in the Lords. So it's great to see that amendment pass in the Lords, and as Martin Lewis said, that gives us a good platform for discussions now about this is a big serious issue. Great to hear Martin say it's the #1 issue for mortgage money saving experts. So, but it's given us a good platform. But I say with an 80 majority in the Commons, the amendment was never going to go through the Commons. But it does give us a platform to work on this. I had lots of conversations that day with the Chancellor and with the Economic Secretary of the Treasury about action they would take and their determination to find a solution to this. So that again, those are I absolutely hold them to their word on that, and I absolutely believe that that's what they want to do. So we need to find alternatives. Rachel's has outlined one we've certainly looking at, which is some kind of mortgage guarantee scheme. There's other alternatives we're looking at as well that we're proposing to the government. Absolutely support the moratorium that Rachel talks about, and there's something we've already in discussions with various ministers on. But we need to find a solution, a workable solution. It will mean some kind of taxpayer subsidy for this. I think there's no question about that. But nevertheless, I think the idea of the SVR cap being a nuclear option was never likely to go through, but it was likely to draw attention to the issue. And I think it's great to see people like Martin who is coming into this space and having these kind of putting pressure on the government like he is. I think with that kind of support, I think the government will act. We just need to keep the momentum. We don't want to lose any impetus on the back of disappointments around what happened through the parliamentary process. I think we just keep on until we find a solution that's going to work for those, I think, probably 300,000 or 400,000 people, realistically. Yes, households might be 125,000, but probably more like 300,000 or 400,000 people that are affected by the mortgage prisoner scandal.
Kevin, thank you very much indeed for taking time to be with us this evening and for your ongoing support around this particular cause. Can we please show our appreciation to Kevin Hollin-Rake MP? Thank you very much indeed. Thank you. And we've got Seema with us. So Seema, if you're happy to, please take yourself off mute and share with us your thoughts. And thanks again for being here, Seema. Thank you.
Well, thank you very much, Andy. It's also very good to be able to follow Kevin. I think he's laid out a number of areas, and so I hope what I say is going to be quite complementary. It's just something I really wanted to do to join tonight and to perhaps share just some of the thoughts that we had raised in the House of Commons, some of the arguments that have been made as well. And I think coming to your point about why this is a scandal, just to share that perspective, and also a little bit about what we think should happen next. Firstly, I should also join in thanking and pay tribute to Rachel and to Jill and to the Mortgage Prisoners Group for their, what I describe as incredible resilience, and also the way that they've worked with the all-party parliamentary group on mortgage prisoners, which I co-chair with Lord Sharkey, which has always been about trying to get a pragmatic solution to the problems that we know mortgage prisoners are facing. I first came across the issue with my constituent, Mohammed Masood, who I watched Panorama with, and who brought the issue to my attention after his family's own experience. And it's hugely frustrating that this is a situation that continues to be ongoing for him and for many, many thousands of other families. I also want to just acknowledge the work of Martin Lewis and team for the very strong advocacy, and particularly in recent months as well, which I know has helped shift some parliamentarians and their views on this issue, and to make this become a mainstream parliamentary issue. I think Kevin will probably agree that we have sort of wanted to make this become a sort of wider issue, that we had some wider parliamentary traction. It is it's like trying to turn a tanker. Parliament isn't a fast beast, but slowly building awareness and slowly building recognition and joining up the dots of what happens for one person in one constituency with what's happening for one person in another has been a very important part of this. So I think that the APPG, the all-party parliamentary group, is now growing in significance in how the Commons and the Lords are now looking at this issue. And I did support, as Kevin has mentioned, the sort of the Lords Amendment, which was passed in the Lords and then lost in the Commons because the government didn't support it. And not to be technical, but basically, a house is built of bricks, and the law and legislation is built of clauses, and those clauses are just bits of text. And when we have an amendment, it's just amending or adding a bit of text or deleting a bit of text. That's what we do. So the amendment was really an addition to the clauses that were already in the bill, Financial Services Bill. And it was basically to say that there should be a cap on the standard variable rate for the specific circumstances of mortgage prisoners, and they're identifiable, and it shouldn't affect the wider market if you brought that targeted protection in that would provide immediate relief for those 250,000 mortgage prisoners. That's the FCA's estimate as well, and then be able to ensure that they can access fixed rate deals. So these arguments were made very powerfully, but Kevin's also gone through what the government said were reasons why it wasn't supporting, but the onus now being on the government to find an alternative solution, because clearly the mood of the House is that this is an issue that needs and demands attention, and it cannot continue as it is. The 250,000 mortgage prisoners who took out their mortgages prior to the financial crisis over 10 years ago did so with fully regulated high street banks like Northern Rock. They have then been kept trapped on these high standard variable rates before being sold to what I would call mortgage loan sharks. And I think that's the way to describe what's happening. It's mortgage loan sharks like Cerberus, Tulip and Heliodor. And so this amendment, which is still on the, whilst it's not in the legislation, has still been now kind of raised in the House as a need, as a kind of, as Kevin described, a sort of nuclear option, if you like, targeted, would be to help provide that immediate protection for those mortgage prisoners with inactive lenders and unregulated entities. We also know that the margins on these Northern Rock mortgages increased significantly as interest rates available to people at active lenders actually fell. Where the mortgage prisoners had been on high SVRs and then had those mortgages sold off, those vulture funds kept them on those highest high SVRs, and And when the government sold on those loans, it also gave some of those purchasers of the loans, like Tulip Mortgages, complete discretion on interest rate policy after 12 months. So and then protections for later packages of mortgages sold only required the SVR to be kept at the level of the third highest of a basket of 15 SVRs, which was higher than the current rate charged to mortgage prisoners as well. So if mortgage prisoners had been entitled to new deals on the same basis as other customers, then the average rate that they would be paying would be 1.8%, which is lower even than the SVR cap that we were calling for of 2.1%. Publicly, the minister, it's interesting, had suggested that the SVRs paid by mortgage prisoners are just 0.4% higher than SVRs at other lenders. Now, analysis, when you look at the facts more widely, just suggests that is not true. And it's just inexplicable to me that the government hasn't updated that line that it takes. Because if you look at the reality, these are families across the country, including nurses, teachers, members of the armed forces, as we know, small business people. Their reality, the reality of those hundreds of thousands of mortgage prisoners, is telling another story. And so some of these attempts that the government does of comparing rates by borrowers at different lenders and inactive lenders, it is a misleading picture, and it doesn't tell the true story of what is actually happening for those mortgage prisoners. And look, we know that mortgage prisoners have been stuck on high SVRs for over 10 years. Their mortgages were sold by the government without their consent, without the proper protections. And people trapped on these high interest rates, they don't have the chance to reduce the amount that they owe. This is also starting to mean that when their mortgages finish, when they're in their 60s or 70s, these mortgage loan sharks often then put pressure on them to sell or threaten to repossess their homes. So the story doesn't end. And what's frustrating for us is that the FCA and the government have claimed to help mortgage prisoners by changing rules on the affordability tests. But we all know there's been a very slow take up of those new flexibilities. And the FCA's own cost benefit analysis published when the rules were proposed estimated that 2,000 of the 14,000 mortgage prisoners would actually switch using the new rules. We've had reports, and including from campaign groups and the mortgage prisoners groups, that very few have actually been able to switch so far. And that's why, just in summary, this is a scandal, because mortgage prisoners have been neglected for over 10 years. Families have been destroyed, homes have been lost. And so the government has the option now of coming up with an alternative proposal to provide that urgently needed relief that mortgage prisoners so desperately need. It has been a story of market failure. Kevin was absolutely right on that. And it is time that the government stepped up, really stepped up, because we need to see an end to this scandal. And we also need to find ways in which this is never going to happen again, including through how the FCA's powers and scope of its powers need to be reformed. Thank you.
Seema, thank you very much indeed. Great to have your input here. Clearly, this is a topic that matters a lot to you personally, as well as in terms of fighting for the cause itself. Can we please show our appreciation to Seema? Thank you very much indeed. And we've got time for probably one or two questions before Seema, and I guess Kevin has to disappear as well. So please raise your hand digitally if you can. Use Zoom to raise a hand if you'd like to make a quick point. Of course, we need to keep this civil and polite and courteous. It's very, very important that we do that because otherwise we lose the opportunity for ongoing engagement and support. We're going to go to Nicholas Wilson first of all. Nicholas, your point, please. Please be brief so we can squeeze a few.
Very brief, and I've said this before on others of your symposiums, Andy. We always talk about these things as though they just happen, but the fact is there are people behind this. And I would like any legal experts to say, can we attack Richard Banks, who was the CEO of the UK Asset Resolution Service, and then he became he's now a director of Topaz Finance, which owns Heliodor Mortgages. Isn't that insider trading? I mean, that man is making a fortune from our predicament. And I think we should focus on the people. That's all I have to say.
Thank you, Nicholas. I get your point, and let's have a conversation about that. That's interesting. Does anybody else have a point they'd like to make at this stage? If you do, raise your hand digitally if you can, because I can't see everybody at one go because there are so many people here. Cara M has raised her hand. Cara, please make your point. Thank you.
Hi. Yeah, around the same point. The head of, or one of the chair people of Northern Rock was a lady called Nicola Peace, and her husband made millions of pounds from sort of trading against the failure of Northern Rock. So that there's definitely people at the top that are implicated, and I just think there needs to be a lot more investigation into those people. So I agree with the previous person.
Thank you very much indeed, Cara, for your point. We've now got Jacqueline Lee Liz has raised her hand as well. Jacqueline, to you, please. And then after one or two more, we'll go to Kevin and Seema for any reflections on the points that have been made by attendees. Jacqueline, to you. Thank you.
Good evening, everybody. This is Jackie. I'm a chartered financial planner, professional, a solicitor, and I'm a mortgage prisoner.
Wow.
You would think that I should have known better. I shouldn't have got trapped. So it just tells you how easily this can happen. And it's not just being a mortgage prisoner. Richard on the chat said, he talks about utilities on the chat just now.
Yes.
And he's not the only one. I'm stuck with gas, electric, all of that, too expensive because I can't move that either. Because once you have a problem, it rolls on. So when Nicholas Wilson mentioned the money they're making it in making our lives a misery in more ways than one.
Understood. Thank you very much indeed, Jackie, for sharing your point. We do have a couple of other hands up, but I need to manage time pretty tightly because I know Seema needs to disappear shortly. Seema, I'll go to you first, if I may. Any further comments based upon what's just been said, and then we'll go to Kevin for any thoughts before he needs to disappear as well. Seema, to you. Thank you.
Yes, look, I think accountability is a really key part of this. Accountability both within government and accountability for, and for what happened and how that compared to the public announcements, whether that was in response to questions, as Kevin also mentioned, in response to John McFall when he was raising this a couple of years back. So, I think we can certainly reflect as the sort of, as in with you as well, and on different ways in which we can move forward. We're also just needing to try and get a solution, and to make sure that, as well as the sort of accountability for what's happened and who's gained from this, because it is a story that must continue to be told. I think it is a scandal, and it should have further investigation. And we should think of the different routes for that. I'm very open to that. But also, I think we've got to really keep the government's feet to the fire. It said that it would look for an alternative. We need to know what's happening, and we need to happen quickly.
Thank you, Seema. Thank you very much indeed. And Kevin, any final comments from yourself, please?
Yeah, thanks, Andy. Can I say that? I mean, I am a massive believer in the free market system. It brings so many benefits to people's lives, which is why we've got to keep improving it. And there are certain things that are just unacceptable. And I think Nicholas Wilson there and others mentioned something that I really don't think is acceptable, which is this revolving door between different, be it government departments and private sector, or different agencies and other commercial entities. So I really think we've got to look at the rules around that. It's so important, if we believe in a system, that we make other people believe in it too. Otherwise, it comes crashing down. If people think the game is fixed, people don't play it, which is the worst thing possible, and people lose faith in it. So really, I think it's hugely important we do make some changes, whether to be those rules around revolving door. And indeed, I think there needs to be cultural change in terms of how we look at these kind of issues. I think what's happened with both the SME scandal, in terms of especially RBS and Lloyds, and the mortgage prisoner scandal, which I said earlier, are connected, in my view, is that we seem to think it's okay to leave some people behind for the greater good. And of course, it's a greater good to get taxpayers' money back. But to just regard some people, some cohorts, which may be a minority in the scheme of things, as collateral damage is simply unacceptable. So I think there's huge lessons we've got to learn from this. The key thing we've got to do now is find a way through this. Wherefore, it seems absolutely right. The current measures are very ineffective and help a very small proportion of the people who are in this situation. So we've got to redouble our efforts, find a solution to this particular problem, but also solve the much wider cultural issues we have that exist in our economy at the moment.
Kevin, thank you very much indeed. Let's take a chance, take the opportunity, everybody, to show our appreciation for all the speakers so far, Rachel and Seema and Kevin. Thank you very much indeed. And what we're going to do now, I'm going to assume that Seema and Kevin are going to have to disappear because they've got schedules that need sorting out, etc. I'm going to invite those who've raised their hand to make a comment to do so. We're going to go to Richard Seddon first, then to Mr. Ian Tyler, then to Ian Lightbody. So, Mr. Richard Seddon, if you can keep it very brief for me, that would be great. Richard, please share your point. Thank you.
Hi guys. Yeah, I raised it in the group the other day. I have prostate cancer, and I'm trying to negotiate a deal with Heliodor to have reduced payments, and they asked me if I still had cancer. I just think it's shocking.
Right. Thank you, Richard. I don't really know what to say to that, but crikey. Crikey. Keep at it. Keep at it. Thank you, Richard. Mr. Ian Tyler.
It's partly a question, but I thought mortgages had been brought into being a regulated contract as part of extending the FCA's powers. And if that's the case, I don't understand why the FCA isn't all over this on the principle of, treating customers fairly. I mean, they have a duty to do that. And well, they actually say the firms have a duty to do that. And it's blatantly obvious these are doing exactly the opposite. They're not treating customers fairly. They're taking advantage of customers who are in a weak position. It's exactly the opposite. So I unless there's some reason that these mortgages are still outside regulation, which I'm not aware of, but I believed that mortgages were now all within the remit of the FCA. So yeah.
Ian, thank you. That thought had crossed my mind as well. I'm sure somebody's going to come up with a much better explanation than what I'm about to say, because it's probably wrong anyway. But my understanding is that the companies that bought the books are not regulated, so therefore the regulations somehow don't apply. Even just saying that, it doesn't really make much sense, but that's my understanding. I'm sure somebody will enlighten us later.
The firms are not regulated, but the contracts are.
The contracts are.
So so I agree that they could do stuff on the funding side, which we had no influence, but the contract with the client should be, in my opinion. But yeah.
Thank you. Arjan just put a, forgive me if I've mispronounced your first name, Arjan, but Arjan just put a point in the chat. He said that they are outside regulation, only the origination was, and the servicing is regulated. This is clearly a major issue, and perhaps the lawyers we have with us are going to be able to comment on this later. We're going to go very quickly to Mr. Ian Lightbody. Your point, please. Thank you, Ian.
I must admit I'm not a mortgage prisoner, but I may be in the future. I'm an SME advocate for SME victims in banking. Can I just reiterate that what the money saving expert said earlier? This is basically not going to be a quick fix. The fight is not over, and I think you've got to take strength from the people, for instance, in the pensions industry with Equitable Life, the Hillsborough disaster in 1989, Stephen Lawrence's situation, and even recently the post office situation. Rachel, we were right there for you, you know that, and we worked very closely with you, but you've got to, these are stepping stones towards success, and you're getting there. You are really doing well, and we're just trying to send the strength over to you. You've actually overtaken us in relation to we have similar issues with Cerberus, for instance, who are a vulture fund. Cerberus is for those of you who don't know it, Cerberus is the three-headed dog who guards the hell. So, I mean, who would name their company, such a thing? But there are people, if you look back in mythology, the Cerberus could be tackled, and you must keep strong, and that is the case. To answer the question just quickly about, I think, you know, the government have been complicit. Kevin's away now, but I can now talk behind his back. But the fact is that, you know, the government sold these loans. They wanted their money back as quick as possible, but they sold them to unregulated lenders. The judiciary is wrong. I've been in court in Glasgow and I've been in court in Edinburgh watching people getting slaughtered, where the judiciary basically say it was all right for a bank to sell a loan to another bank. They're not another bank, they're an unregulated vulture fund. So there's a lot of you know, a lot of mileage still to be had, but please keep strong. And the fact is, you know, we will be there with you all along, and then you know, we will stand together when we win this battle. So and Andy, great, you know, I don't know where Cat McShane is, but again, great, keep in touch with people like Cat McShane, Andy Faherty, and you know, the journalists who are helping these cases. They're fantastic people, and you will prevail. So please keep strong.
Thank you, Ian.
Thank you, Ian.
Thank you very much indeed, Ian. But there are a few others that have comments and questions that they'd like to make. We'll come to those later. What we're going to do now is invite Professor Sharon Collard to share her thoughts. So Sharon, please do take yourself off mute, and over to you. Thank you very much. Thank you.
Hi, Andy. Thanks very much, and thanks everybody for inviting me here this evening to speak. When I discussed the event with Rachel Neal, she had asked me to talk a little bit about thinking about mortgage prisoners through the lens of vulnerability and the lens of harm. So I'm not going to be telling you anything that you're not already living, but I am going to kind of think about it from those two kind of lenses. So I'm going to share my screen. I hope people can see it. So yeah, so as I say, I was just going to think about it for like 10 minutes through two different lenses, the lens of vulnerability and the lens of harm. Just in terms of, you know, perhaps it might be helpful in thinking about framing the campaign. If there's anything, you know, there might be something useful in it. There may not, you can tell me either way. So the vulnerability, there's a lot of talk in financial services about vulnerability and vulnerable customers. The Financial Conduct Authority has been looking at the issue of vulnerable customers for about 8 years. And its most recent guidance for firms was published in February, and its guidance on the fair treatment of vulnerable customers. And how they define a vulnerable customer is it's someone who, due to their personal circumstances, is especially susceptible to harm, particularly when a firm is not acting with appropriate levels of care. And of course, in this context, as we've already had a discussion around, when we're talking about firms, we're talking about firms that the FCA regulates. So what this is getting at is, you know, that some of the characteristics, the things that kind of make people vulnerable are things like all of the things really that the mortgage prisoners are experiencing. So it's health issues, mental and physical health issues. It's life events like losing your job or having a serious terminal illness. It's also about low resilience. So things like low financial resilience, which means kind of you don't have much margin to work with, perhaps because of your situation, or emotional resilience. So I would say that's a fairly narrow lens of vulnerability that the FCA is taking. It's serving a particular purpose to try and encourage firms to treat their vulnerable customers better and to identify and support people in vulnerable situations. Of course, for many of you, that's not going to be relevant because you're not with a regulated firm, as we've already talked about. But I think some of the ideas behind it are quite useful, just in thinking about what the situation of yourselves as mortgage prisoners are. My kind of take on it, this is my idea of you know, a broader vulnerability lens. So it's thinking about what harm are people vulnerable to and how have they been made vulnerable to that harm. And I would say there's kind of 4 pillars to this, not just the consumer firm interaction. There's how consumers are made more or less vulnerable to harm by government, which we've already kind of talked about. That might be ideology, it might be legislation, it might be public policy. The second pillar is around how consumers are made more or less vulnerable to harm by the regulator itself. That's things like what's in the rule book, questions about what rules it has and who is within its perimeter. It's questions about who it authorises, supervises, how it enforces. It's also about things like research and insight. What does it look at and what does it not look at? But the other thing that I haven't got in there that I think is really important is it's about what risk appetite does the regulator have? How ready is it to kind of take risks and face judicial review or face challenge? I think that's relevant here as well. The third thing is around how consumers are made more or less vulnerable to harm by the industry. And that might be how industries operate, and that might be relevant to organisations like the non-regulated inactive lenders like Cerberus and others. You know, do they have any self-regulation? Are there any codes of practice? Maybe not. If there is, they're probably not very effective. And the fourth one, which I won't go into any detail about, is how are consumers made more or less vulnerable by individual firms. And this fourth bit is the bit that the FCA's guidance really relates to. So it's about culture, which we've already talked about. Excuse me. It's about business models, governance, staff incentives, and firm customer interactions. So that's just some thoughts on the kind of vulnerability lens, and actually how a broader lens about how all of these things can make people vulnerable to harm. It's not just about firms, it's about government, it's about regulators, and it's about industry. Picking up on the theme about harm, I think there is, having looked at the mortgage prisoners research itself, I've been doing a lot of work on gambling recently, and this framework that I've got here on the left is a conceptual framework of gambling related harm. But when Rachel and I were talking about this event beforehand, I was saying, oh, well, this is a framework that I've come across. It seems like there's a lot of crossover between what mortgage prisoners are facing and between, what people face when they're at risk of gambling harm. And the reason I think it's a useful conceptual framework is that we've got several dimensions going on. So the verticals are the dimensions of harm. These are the harms that people like yourselves actually experience. Financial harm, relationship harm, emotional, psychological distress, health impacts, social and cultural harm, reduced performance at work or in study or in life. We've also got criminal activity in there. I think probably isn't at all relevant to mortgage prisoners. It's relevant to people who gamble. So the things that we know from the mortgage prisoners' own research is that, in terms of financial harm, research that you've done, that you've contributed to, shows that almost all mortgage prisoners feel that they're in a poverty trap. Financial harm also comes about because of the extra costs and the impact on your quality of life, because you're unable to upkeep your property. And that was something really striking I found from the research that you've all contributed to, is actually you can't repair the homes that you live in, you can't maintain them because of the costs that you're paying on your mortgages. The research also shows strain on relationships, and about 3/4 of mortgage prisoners report stress and anxiety. And that, of course, leads then to other health problems, has impacts on relationships. It's all kind of confounding. And little or no social interaction, no money, no time to do that, and very little downtime. So that's where I think that your experience as mortgage prisoners maps onto that conceptual framework. I think the other thing that's helpful is that it has a kind of time element. So it talks about general harms, which are harms that you are experiencing day to day. So that's things like worry about being able to pay the mortgage, being able to pay other costs, not being able to switch utilities. Also crisis harms, and this is where something comes to a head. So it might be court action around repossession or actually being repossessed. So it's something when something really badly goes wrong. But the other thing that strikes me is that it talks about legacy harms. And as Rachel and others have talked about, you've been living with this for 12 years. You've been living the legacy of this situation. And that is things like, ongoing issues around health and finances, impaired credit records, again, not being able to, to switch or move on in other parts of your life. The third bit of the framework is around the kind of the life course, which is over your own life course, the generational impacts between, which is in your own generation, and then intergenerational harm. So again, I think this speaks to the really kind of, it's just a very powerful way of thinking about how harm not only affects yourselves and your immediate families, but it goes on to affect others around you in the future. And so I think that that idea of actually it's not a static thing, it's a dynamic thing, it has a legacy. I just wanted to speak really quickly about intergenerational harm, and I know Nicole and Cara and Anne's research on hidden voices growing up as a child of a mortgage prisoner is what I base this on. So the intergenerational harm that they pick up on is around family life and relationships. So, not parents working so many hours and being so worried that, family time is limited, children's health, mental health and well-being being affected, educational and social opportunities also being impacted, not being able to go on school trips, limiting your expectations, not being able to take part in extracurricular activities, and ultimately that impact on life opportunities. And in amongst all of that, all of the emotion and the stress for both children, young people and parents and wider family in all of that. I've just put a couple of quotes there from Nicole, Cara and Anne's research, which I think really brings it home. These are young people talking about their experience. So that's why I just wonder whether this kind of conceptual framework of harm might be helpful in terms of thinking about how to talk about the impacts that there have been and kind of framing the research that you've put so much effort into producing. I just wanted to end by thinking about quantifying the social costs. It's quite difficult to quantify the social costs of the situations that you're in. But this is an example from Step Change Debt Charity that back in 2014 tried to quantify the cost of problem debt for its clients. So this is kind of a snapshot about how much, as a social cost problem debt is in the UK. And while not all of these things, just like the conceptual framework, not all of this will be relevant to mortgage prisoners, I think a lot of it is, and putting numbers to it could potentially be helpful. It's a bit like what Seema was saying about finding terms, finding ways to talk about it and maybe trying to put some numbers to it as well. So the ones that stand out to me, for example, are the 2.8 billion cost of losing a home or being evicted, the 960 million cost of mental health, mental ill health and mental health problems, the 790 million cost of relationship breakdown. And at the top there, the 89 million pounds worth of cost due to worse education and employment outcomes for young people, as we were speaking about intergenerational harm as well, and costs related to poor physical health. So those are just some ideas that I may or may not be useful, but thank you for inviting me to speak. I really do appreciate it, and I know you've got a lot to talk about today, so I'll end it there. But that's my contact details if anybody would like to know more. Thank you very much.
Sharon, in all honesty, I think that was an absolutely first-class presentation. It really was extremely interesting, highly relevant, and I'm sure everybody in the session will want to join me in thanking you for what you've just set out. Thank you very, very much indeed. We are going to go to some questions and catch up on the loose ends, whether directly relating to the presentation we've just heard or others. So bear with me while I just get myself organised for that. We're going to go to Paul King first. If I can please ask everybody to be as succinct as you can be, so we don't run out of time later. Short comments, questions, short comments, responses, if possible, please. Paul King, you're next. Take yourself off mute and go. Thank you.
Thank you for reminding me to take myself off mute. If I may thank all of the speakers, especially the MPs. It's been an absolute pleasure to hear such impassioned, intelligent, articulated responses, entirely different to that which we received from John Glenn. I would like to just suggest that the argument, that the resolution is not going to be found in lengthy arguments, but to address the cause and not the consequence of the issue. So the cause of the issue was a Treasury Select Committee who, faced with a financial crisis, had limited access to adequate legal advice in the time available to them, and took some decisions which, however we look at it, those decisions were made, and we can all have 20/20 hindsight and say, do you know what, they could have done something better. So they made mistakes and we're all suffering from it. So the government ultimately are just administrators. MPs represent their local electorate, and they take that up to government, who administer to either, you know, police, health and safety, nursing, that sort of thing, or they go down the Labour route, whichever. The issue that I think we have is not going to be addressed by government, because it was a Conservative government that ultimately caused the issues. And I'm a Conservative voter, I'm an employer. The issue is really to be resolved by Parliament. And perhaps we need to stop thinking we're going to have a battle and run it through the courts, but run it back up to Parliament, who are ultimately responsible for governance. So what I would suggest is that our blame culture at the moment prohibits anybody from putting their hand up, because as soon as they put their hand up, they're expected to fall on their sword and be a victim. And then in 5 years' time, they're allowed back into Parliament. We need to move away from the blame culture. So I've got a couple of notes here. The government of the day are but administrators. It's a civil service, and I've done a lot of work with civil servants throughout multiple governments, health and pensions, whatever. John Glenn is being advised by the civil servants, and that's where these stupid figures come from. The people like Rachel Neal have done a fantastic job getting the facts out there. The advice received by John Glenn is such that he cannot admit to it because he's not allowed to, and why would he? He represents the same government that caused the issues, mistakenly. But if we move on from the blame culture and allow people to put their hand up and go, do you know what, a mistake was made, let's sort it out, go through Parliament, don't try and go through the courts, and massive respect for those who want to talk about the consequences. I'm more interested in dealing with what caused the issues.
Paul, I'm going to need to hold you there, so we need to manage time well. So thank you for sharing your point. Appreciate that. And let's move on to Janice, please. Thank you, Janice.
Hello, everybody. The harm Sharon spoke of there, I too have experienced. I just wanted to broaden the discussion slightly for anyone listening. Rachel very kindly acknowledges that there are many mortgage prisoners with active high street lenders. I am one of those, a former solicitor, a vulnerable customer who has been subjected to harm. Mortgage prisoners with active lenders are such due to being trapped with their lenders post-crash, often on high rates and high SVRs, and can't move. They can't move because of the new affordability criteria. They can't move because loan to values have changed post-crash. Kevin Hollenrake said that the FCA brought in exemptions to affordability criteria for those with active lenders. This, however, did not deal with the problem adequately. The scope is very limited. For example, you're not allowed any changes in the sum to lower it, never mind to raise it. The type of mortgage. Loan to value drives the ability to access rates other than the SVRs. And the changes did not address in any way the loan to value changes after the crash, where equity was wiped out. Margins between SVRs and base rates with active lenders also have diverged significantly from pre-crash margins. Can I just suggest that there is a lot more to mortgage prison than meets the eye?
Janice, thank you very much indeed. A very compelling set of points. I need to manage time pretty tightly for everybody's benefit. So what we're going to do now is move straight on to our next speakers. So we're going to move on to Olivia and Edward. Olivia, Edward, please take yourselves off mute and introduce yourselves, of course, and share with us what your thoughts are around this mortgage prisoners scandal issue. Thank you.
Hiya, thank you for that introduction. My name's Olivia. I'm an associate at Harkers Parker, and I've been working on the mortgage prisoner litigation for about a year. I work very closely with Ed Argles, who I'm speaking with this evening, and we work together with a team of about 6 others under the supervision of Damon Parker, the firm's managing partner, who I think is in the virtual audience somewhere tonight. Firstly, thank you for having us to speak. It's very rare as litigants that we get the opportunity to talk about our claims in a sort of non-contentious environment, so we're very grateful for that. And I want to start by saying that the Transparency Task Force is a very appropriate platform for discussion on mortgage prisoners. You know, it's rightly asked, you know, why is it that mortgage prisoners have been trapped paying these very, very high standard reversionary rates of interest for so long? Well, it's partly due to a lack of transparency. Certainly, so far as consumers are concerned, the mortgage market really isn't very transparent. You know, as we all know now, mortgages can be bought and sold, active lenders can become inactive, mortgage portfolios can be securitized and then re-securitized. And all of these things introduce complexity into what is otherwise a straightforward proposition, you know, a mortgage. And these things put obstacles in the way for consumers who just really want to articulate that they've been treated unfairly in the levels of interest that they've been charged. So in bringing the claims at Harcus Parker, we've been taking into account all of that complexity, but really just trying to cut through it and articulate the unfairness in a really concise legal claim. And that's what we've done. And that's what I want to talk to you about this evening is the core mortgage prisoner claim that we're advancing on behalf of mortgage prisoners. And I should say that the claims, you know, there's no guarantee of success, but they represent a real opportunity for mortgage prisoners to realise compensation for years of overcharged interest. So the core mortgage prisoner claim, and I call it the core claim because we are advancing a number of other claims, but the core claim is the one that applies universally to all our mortgage prisoner clients. And it's a claim for breach of contract. And we say that the levels at which lenders have set their interest rate has been in breach of contract. And so generally speaking, in a mortgage contract, especially one that reverts to a variable rate, lenders do have broad discretion at the levels they can set interest. But it's not completely unlimited. You know, they can't charge whatever they like. Their discretion is in fact limited. And we say that it's limited by virtue of an implied term of the mortgage agreement. So an implied term is one you won't actually see written in ink in the contract, but it's one that's interpreted as being present in the agreement. The agreement is interpreted as though it is in fact written there. And in this case, the implied term is a term which states that when a lender is exercising their discretion to set and vary interest rates, they must not act in a way that is arbitrary, capricious, or unreasonable. And unreasonable here really means that they must not act in a manner that no reasonable lender acting reasonably would do. And so we say that in setting the interest rates in the way that they have, lenders have failed to take into account certain important considerations. So they've failed to take into account, in many cases, that they're inactive lenders. They've failed to take into account the unique trapped position that mortgage prisoners find themselves in. And they've really failed to take into account their obligations to treat customers fairly. And I'm thinking here about something that's been mentioned before this evening, but FCA principles which really require lenders to have due regard to a customer's interests and treat them fairly. So the upshot of all these failings is that people have been overcharged for a very, very long time. So if one is to advance a claim that the interest rates that have been charged are unfair, one has to come up with an idea about what a fair rate might have been. And here it's not really possible to look at rates in the abstract, you know, compare 6% with 2% and conclude that the 6 is unfair. You really have to interrogate some of the factors which underpin the setting of SVRs. And different lenders will indeed have different commercial considerations, of course, but broadly they're going to include a few sort of familiar things. So funding costs. What does it cost the lender to advance the lending? Operational costs. What are the costs of running their business? What are their regulatory capital requirements? So how much money do they have to keep in the kitty to sort of hedge against their lending? And how much risk is there in the mortgage portfolio? So it is possible to interrogate to what extent any one of those factors or any combination of those factors might justify the interest rate that's being charged, or to the contrary. And we've been spending quite a lot of time looking at this. And the very, very satisfying thing to see is that coming out of the data, of which there is a lot of data to analyse, is data which supports those instinctive feelings of unfairness that we've all shared for a very long time about mortgage prisoners. So I'm going to just give two quite top line examples of the types of things that we're seeing. And again, a couple of them have been touched on already this evening. But as we know, following the financial crisis, the Bank of England base rate plummeted and has remained consistently low to date. And even in fact, with the onset of COVID, it's fallen even lower. And yet the rates of interest that various lenders have charged haven't fallen at all. Indeed, they seem to remain consistent to the rates that they were charging at the height of the financial crisis. So essentially this suggests that lenders may have become making more profit on these portfolios. Their margins have improved. But I should be careful here to say that I'm not suggesting that lenders are obligated to pass on Bank of England base rate decreases. In many cases, they're not obligated to, but I'm using the Bank of England base rate here as sort of proxy for costs of lending in the market more generally. So that's the first thing we're seeing. Another one is that over time, mortgage portfolios mature, and they seem to have been maturing in a way that's quite advantageous to lenders. So notwithstanding the fact that so many of the borrowers in the portfolio are mortgage prisoners, they're paying down their mortgage, they're increasing the equity, reducing their loan to value ratio. So that's minimizing the risk for the lender. And again, the same point, they're not reducing their interest rates in a way that reflects the reduction in risk. So generally what can be seen as a pattern emerging that essentially the financial and lending landscape for lenders is improving, but mortgage prisoners are continuing to be squeezed in a way that's not reflective of the risk that their mortgages pose. And I should say it's just a bit of a taste of what we've been doing, but really the sort of number crunching and the data analysis is kind of not our forte, and we have instructed independent experts to really dive into the data in a granular level. And ultimately it's going to be their conclusions and their findings which allow us to then go on and articulate the claims fully in the very near future. So I'm going to hand over to Ed, who's somewhere, I can't see him on my screen, and he's going to talk about some of the positions lenders take in respect of their SVRs and how they potentially pose more questions than they actually give answers. So over to you, Ed.
When the government acquired the mortgage portfolios of Northern Rock and other lenders during the financial crisis, it had a dilemma on its hand. On the one hand, it had an incentive to increase interest rates to a high level, to make the mortgage portfolios more attractive to potential buyers, and to recoup some of what the government has spent in bailing out the banks. On the other hand, it could not be seen to be treating the borrowers whose mortgages it acquired unfairly by setting interest rates at a higher level, nor could it be seen to allow the lenders to whom it sold the mortgages to take advantage of customers by setting the interest rates at a high level. It got around this problem through what it called its customer treatment conditions. And the customer treatment conditions were what it said guaranteed the fair treatment of borrowers. One condition provided that the SVR, both of the government-owned mortgages and of the SVRs of the mortgages of the lenders who acquired the government-owned mortgages, had to be set with reference to the third highest of the top 15 active lenders in the mortgage market. This, therefore, was what the government said was a fair way of setting the interest rates. But is it fair? We say no, it's not fair in the circumstances in which the mortgage prisoners found themselves. Of course, having a high interest rate is not in and of itself unfair. A lender may have legitimate commercial reasons for setting a high interest rate. And we are sure that the defendant lenders will say that they had proper and genuine business reasons for setting their interest rates in the way that they did. To take NRAM, for example, and NRAM held was a government-owned entity who held the former Northern Rock mortgages. They could say that their legitimate objectives in setting their interest rates in the way that they did included the need to mitigate the anti-competitive effects of the state aid which had been received by Northern Rock, and to wind down its business. And this was a justification for setting its interest rates it set its interest rates at a high level to encourage redemptions and to encourage borrowers to take out cheaper mortgages with other lenders. We say, however, this is irrational in the sense that it was an approach which was unreasonable in the way that no reasonable lender would have acted. And also, but it failed to take into account both the expectations of Northern Rock and the borrowers at the time they entered into their mortgages. NRAM knew that many of its customers could not redeem their mortgages. So in effect, what it did was set its interest rates at a high level to encourage redemptions, knowing that in many cases it could not possibly achieve that result. Where you have a policy which you know is ineffective, but you persist in having it anyway, we say that's irrational. It does not make sense and cannot be justified on a reasonable basis. Now, turning back to the customer treatment conditions and that mechanism for setting, the mechanism used by inactive lenders for setting their SVRs with reference to the SVRs of active lenders, and the argument they use that this is a fair way of setting interest rates, we say that this does not take into account the fundamental difference in the nature of the SVRs of an active lender and an inactive lender. The SVR of an active lender is much more of a marketing ploy, in the sense that a borrower with an active lender who is on an introductory rate and due to move on to a higher SVR, the high SVR works as an incentive for the borrower to refinance with that lender. Also, active lenders use high SVRs as a way of funding low introductory rates. So they therefore use, active lenders therefore use SVRs as a way of, in conjunction with their introductory rates, and most of their customers will be paying the low introductory rates. In comparison, the SVRs of an inactive lender are much more of a real rate, which borrowers have no choice but to pay, because it's much harder to refinance with a new lender than it is an existing lender. So, so by using this mechanism, setting their SVRs with reference to the SVRs of active lenders, inactive lenders have failed to take into account the sort of different business models of active and inactive lenders, and have failed to take into account the fact that the SVR of an active lender serves a very different purpose, and cannot possibly serve the same purpose as an SVR of as their own SVRs. There's a lot more I can go into on this subject, but the short point is that when you take away all the language which lenders like to use around the fairness and the fair setting of their interest rates, and look at the actual mechanism and justification for setting their interest rates, you can see that one, they've set their interest rates at a high level, and two, they haven't taken into account, or it does not appear to take into account, the change in the nature of Northern Rock and the lenders' businesses when Northern Rock and other lenders withdrew from the market and stopped offering competitive mortgage products. Now I'm going to hand back to Olivia just to sort of sum up.
Thanks, Ed. Yeah, I don't have much further to say other than to say thank you very much for listening. And I hope that what we've been able to achieve is make people realise that this is a very complicated problem, and that is part of the reason individuals aren't necessarily succeeding on their own. And that is really the utility of group action, because there really is strength in numbers. And just a final word to say that if any of you, I've seen some of our clients on the line tonight, but if any of you would want to know more about what we're doing or want to join the litigation, then please do get in touch. So thanks very much.
Very, very good indeed. Extremely interesting. It's great to hear that this battle has been fought out in the way that it is. Let's show our appreciation, of course, to Edward and to Olivia. Thank you very much indeed. And great stuff. We're going to have a Q&A session once we get to the very end of our speakers, so we're going to squeeze as much in as we can. We're going to go now straight to Kat McShane, who's going to tell us about the Trapped by My Mortgage programme. So Kat, please, over to you. Thank you very much.
Thank you, and thanks to everyone for having me this evening. I honestly could never have imagined that the investigation would become such a big part of my life, and how many other people's lives it would go on to touch. But in the making of the programme, it had become clear very quickly that we were unearthing a large number of hidden people who had long felt that something wasn't right with their mortgage, but had thought that this was unique to them, their fault, their personal failure. But it would be some time before the scale of the problem and the programme's key findings would come to light. Just to go back a bit, research for the programme actually began back in 2015 when I was involved in a project looking at the impact on tenants across Europe, where banks, the city and state governments had been selling people's homes to private equity in the aftermath of the financial crash. We didn't actually report on what was happening here in the UK. I had my eye on it, but it wasn't following the same pattern as the rest of Europe. Around the time that we published, the government announced the sale of Northern Rock Mortgages to Cerberus. who I hadn't heard of before, but a quick Google had, obviously revealed that it was an extremely aggressive vulture fund. It took until 2018 for me to get the nod from the BBC to look into what was actually happening since the sale. We thought when we started the film would be about the aggressive treatment of mortgage holders by Cerberus. We did not anticipate the scale of the government's role in this story. It was a very slow and quite puzzled start, as we looked at various mortgage books that had been sold by the government, Bradford and Bingley, Mortgage Express, and those by other lenders like GE Money, also sold as closed books to private equity. We tried every available route to find people with these mortgages and work out what was happening. I scoured Twitter and Facebook for any mention of people seeking help, and that is how I found Rachel, who had stuck a plea on Twitter. We drank coffees at a station cafe and later had much longer meetings at her home, and meeting her was a turning point for the programme's development. Around the same time, I was in touch with Lisa Elkins, who I'd found through Facebook, and I think it was through what was then quite a nascent Mortgage Prisoners UK group on Facebook. Lisa's family were also really struggling to make their mortgage payment every month. They'd had the mortgage a really long time, and they couldn't understand why they still owed what they owed, and found it really difficult to deal with Landmark. And like Rachel, they said, we don't, we feel like something is afoot, but we don't know quite what. And we also scoured daily court listings across the country for repossessions and contacted as many people as possible, which is how we found Sean, who is in the programme. And he, in fact, had given up the fight by the time we met him and was walking away, and we filmed his repossession, in the programme. So everyone was saying the same thing. And as pictures started emerging, most people we spoke to had together mortgages. They had been trying to switch their mortgage for years, and even though a new mortgage would cost them far less each month, they had been refused by every lender they had approached, contributing to this sense of shame. They had also been refused a lower rate by Landmark or sometimes Whistletree, but no one really understood why. This idea that people said, but we took out our mortgage with an active lender. Well, not that people were using the terms active lender. I had taken out a mortgage on the high street. I was advised by my mortgage advisor to take the mortgage out with Northern Rock. And they couldn't understand why they were now with a lender that couldn't actually offer them new deals. Some people we spoke to had gone into debt to service the higher mortgage payment, which was exacerbating the issue of switching. Worryingly, many we spoke to were on interest-only mortgages. They had planned to switch to repayment after the first couple of years, but subsequently not allowed to after the sale of the transfer, and this obviously remains a looming crisis. We also encountered a huge level of frustration with the way that people had been treated both by the government when it owned the mortgages and by Landmark. A whistleblower who worked for UCAR as a customer advisor had already told me she'd left her job because in more recent years, her team was being set unrealistic targets to get arrears down and people were being unfairly repossessed. There was anger at mortgages being bought and sold without permission to seemingly random companies, and people reported Landmark as being equally bad or worse than the government, offering no explanation on how their monthly payments were being allocated and recording errors on their credit files. Many had long correspondence with the Financial Ombudsman Service, often awarded sums of money in compensation. The people I was speaking to were switched on and doing whatever they could, but were totally trapped. And the stress and emotional harm that's been mentioned earlier today was evident. And we got a property expert and a mortgage advisor to run sums on what people had paid for their mortgage since 2008, stuck on the SVR, and what they could have paid if they'd been on a sort of more regular rate with a regular lender. And the differences were staggering. So how could this have happened? Why, when there was an opportunity for the mortgages to be sold to an active lender back in 2015, did they go to Cerberus? Well, we only know part of what happened. I'd been in touch with Dominic Lindley, who had been working with Lord McFall around the time of the sale of the mortgages, and letters between him and various involved parties, like the head of UCAR, someone mentioned Richard Banks, showed him being given firm assurances that Cerberus would be offering new deals, better interest rates. We then found out that they'd been told by the government that they told the government they'd be setting up a challenger bank, which of course we know never came to pass, as Cerberus didn't have the right permissions from the FCA to do that, and apparently never felt the need to start the ball rolling on getting those permissions. And for us, it seemed really bizarre that a promise like this was treated so casually. And instead, the final piece of the story was about the money being made out of the mortgages. All across those years while the government owned the book, all the original investors into these risky mortgages had been paid in full. And now a new set of investors were profiting, both those who were part of Cerberus's securitization process and were getting a tidy sum that hinged on the high SVR, and Cerberus itself, who creams a chunk of money off each year, virtually tax-free. So it's a miserable story where so much money has been made at the expense of so many people and their homes and their well-being. Across filming, people would often ask what I thought the programme would achieve. And I was always cautious, but I became progressively more hopeful as filming progressed. I anticipated that people would band together, and I hoped that there would be compensation and a way through. I never anticipated, as I said, the scale of the problem. I also never thought, I never anticipated how resistant the government would be to resolving this issue in a dignified and positive way. It's a testament to the tenacity of Rachel and the Mortgage Prisoners UK group that the campaign has reached the volume of people it has and shaken the highest branches of our political and financial system. But it's shocking that all these years on, in Westminster just a few weeks ago, mortgage prisoners were still being shamed of, spoken of as irresponsible borrowers. It shows where the allegiance of the government is, and it's so far not with these homeowners, a broader group. They are normally so eager to say they support. I agree that there are parts of the story we don't know around the sale of these books, including who may have financially benefited. Why, despite the campaign, have books continued to be sold to inactive lenders? What is the city's role in this lack of change? But like others here, I think that despite the last vote going against the SVR cap, popular opinion, and that of MPs, including of the Conservative Party, has turned significantly in favour of mortgage prisoners. And I sincerely hope that this is a tide that not even John Glenn can hold back.
That was absolutely fantastic. Thank you so much, Kat. Your programme was wonderful. One quick and obvious question from me, Kat, before we go on to our next speaker, Andrew Montlake. Kat, what's it going to take to get part 2, Trapped by Mortgage, My Mortgage Part 2? It's a serious question. This is a major public interest issue. Your work's been phenomenal. We need more of it. What's it going to take to make that happen, Kat?
Well, I think one thing that's promising is that Andy Verity has managed within his position at the BBC to get to continue covering the story on various platforms. And actually key to that is he got it on things like Victoria Derbyshire, so which really shows the sort of human impact of that. And that encourages other parts of the press also to cover that, because actually the fact that you can see the tone of news articles has changed so much in the last a couple of years. It's really difficult to get like a follow-up on a subject that has already been interrogated within the depth that we have for the same strand. So I wouldn't like to say really about that, although it's definitely a kind of ongoing conversation. So I suppose that the best we cope is that we keep getting the BBC to cover it across whichever platforms it possibly can.
Thank you very much indeed. We look forward to how that develops as time goes by. Kat, superb stuff. Let's all please show our appreciation, not just to what Kat has just said, but also to the programme that helped bring the light of scrutiny to all this disastrous activity that's been going on. Thank you very much indeed, Kat. Mr. Andrew Montlake, you're up next, sir. Please take yourself off mute and go for it. Thank you very much. Thank you.
Thank you very much. First of all, thank you for all having me. I'm a mere mortgage broker and a very simple man. Let me preface everything for that. First of all, I'd like to thank Rachel for I think it was January 2020 when we first met on a podcast that I did that was covering the issue of mortgage prisoners to try and really get the mortgage industry itself more aware of everything, and a more eloquent and passionate proponent of the issues you couldn't find. So you're very, very lucky to have Rachel. And also thank you to the MSE team as well. I think it was the year before that, actually, I went with Martin Lewis and the team there to the Conservative Party conference where he was talking about this issue, again, very passionately and eloquently. Obviously, the whole debate on mortgage prisoners has been with us for some time now, which, as we've already heard tonight, is obviously a very emotive issue and often creates more questions than answers. At first glance, it looks like there should be a simple solution to this, and indeed a moral obligation for the industry and government to come together and find a solution that helps people once and for all. The problem is that in practice, none of this is ever simple, and it is easy to pass the blame for the failure to have come up with anything meaningful onto a number of different parties. The problem is that while we all continue to pontificate, mortgage prisoners and their families continue to suffer. We all know that the 2008 financial crash was caused, at least in part, by lenders granting mortgages too liberally, in some cases without checking whether customers would be able to pay them back. As the credit crunch took hold, some of the main lenders and brokers, for that matter, who had been at the forefront of many of these sales began to disappear, creating the first part of the problem as the government stepped in to assist. The second part of the issue, could be argued, came about as an unintended consequence of the excellent work done by regulators post-crash with affordability changes in the 2014 Mortgage Market Review. Considering what had happened previously, it made perfect sense for the FCA to ask banks to conduct tougher checks and make advice a central part of the process, which from a broker, and I would argue a consumer perspective, was a positive change. Proper affordability considerations enable good brokers to work harder and smarter for their clients and really show their worth. Getting back to the more professional view of what a mortgage broker is and did before the few Wild West years, which none of us still around pine for a return to. They also help to check borrowers and to protect them in many instances. Falling in love with a property and wanting to push every inch of affordability is very, very common. And I've often seen common sense fly out of the window as a "I must have that property at any cost" attitude takes hold. We're seeing quite a bit of that in the market at the moment now. And I did exactly that in 2007. I was fortunate, however, that the market in and around London over the past decade has continued to increase overall. And I was also fortunate that the lender I was with did not have any issues. In another part of the country, with a different lender, this could have looked very different. Any of us could be a mortgage prisoner today. Once these failed lender books started to be sold off to non-bank lenders, often in order to get the best return for the taxpayer who'd helped to bail out the banks, the question was missed by everyone as to how these mortgage borrowers would fare with these lenders, especially when their existing rate expired, or they wanted to move or remortgage. Or worse, it was asked, but was merely filed under "not my problem." The FCA did come up with transitional rules, which helped some, but not a whole host of others. Anyway, we all know the history as to why we are where we are now, but with my mortgage broker hat on, it's always good to revisit the past and basic understanding of a tricky case before you try to place it and find a solution. And I must say, this is perhaps one of the trickiest to place I have seen. So where to start? We could start with the broker community. Brokers by our very nature are meant to be here to help people. It is our raison d'etre. What was interesting and also a proud moment for me was when the FCA called for a show of which brokers would be willing to help with this. A whole host of brokers put their hands up, more than envisaged. What was good about this is that it showed that the broker community cared, that they are willing to do what they can to help, that many of them are already battling to get individual wins for those in need without it just being a money-making exercise. Let's be honest, dealing with mortgage prisoners from a broker perspective is not about turning a few quid. If anything, it is our pro bono moment. However, despite this willingness and empathy shown, the problem for us brokers is simple. We advise on and sell other people's products. Without a range of offerings from lenders and criteria from lenders who have an appetite to help, there really isn't much we can do on a larger scale, apart from continue to get as many little victories as possible where we can. So as far as lenders are concerned, we so far have 4 lenders, Halifax, Santander, West Brom and NatWest, who have official arrangements to help mortgage prisoners, and we thank them for at least trying. They themselves work under guidelines as to what type of customers they can take within this, which will not include those who are on interest only with no repayment plan, or who have had some credit issues, or are in negative equity, for example. And part of the issue also concerns what rates would lenders be able to offer anyway. If we look at high loan to value mortgages now, for those with a good income and an excellent credit score, they're priced around the 4% level. And rates are similar-ish, dependent on lender, for those with some credit issues. So even in the open market, mortgage prisoners may not be able to switch onto a rate that is a far better. Lenders always price for risk. The question that also must be asked is it fair to expect lenders to take on additional risk, especially if they were the ones who were not part of the troop offering riskier deals or 125% loans? And if they decide this is not something they feel they should be doing, can and should they be forced to? For some, it would lead to huge expenses in systems changes to even begin to take on borrowers on a different affordability offering. Or is it as simple as saying, like brokers, lenders, this is also your pro bono moment? Which brings us nicely onto the FCA. Having sat on the mortgage prisoner discussion group with the FCA, you can see a clear will that they want to help, but an ongoing frustration that finding a solution is not easy. Getting to grips with the real data of what the mortgage prisoner population looks like, what are the average loan to values, the credit profiles, ages, and current interest rates being paid is one thing. Asking the question of whether they are able to force individual businesses to take on something they do not feel comfortable with to help a situation not of their own making is another. So you have a situation where the government is seemingly putting pressure on the FCA to sort out an issue, who are themselves putting pressure on lenders to sort out an issue. But is everyone missing a trick? At the top of the tree sits government. Whichever way you look at it, you have a government who are culpable as to where we sit now. This is an issue that, much like the cladding scandal, which is looking at creating a whole new breed of mortgage prisoners, something they can sort. In fact, since their stated commitment to help mortgage prisoners, they've even relatively recently still sold on mortgage books and have actively and passionately blocked a middle ground motion to cap rates for mortgage prisoners. It was a really interesting debate in the House to watch, as I'm sure many of you did. And whilst it would have been unprecedented, whilst it could have opened the door for potential action from companies who had bought these books, whilst it could have opened the doors for others to cry, what about me? This could have been marked very clearly as a one-off situation, a short-term stopgap to help people very much in need after being ignored for so long. And I'm yet to see a pragmatic solution from the government other than trying to force lenders to do more. And I hope that the commitment Mr. Hollinrake obtained in the House to look further at this issue urgently is serious. But perhaps there is another option. The government are very quick to promote new home ownership, giving away guarantees on 95% loan to value mortgages to help more people get onto the housing ladder and encouraging lenders to lend. So why not do the same to solve this issue too? Guaranteed to help people not just buy their homes, but to stay in their homes in this unique situation. Provide a guarantee for the lender up to a certain percentage of the loan that if anything goes wrong, the lender will not lose out. To really look at affordability in its most simplistic terms, you're meeting the payments now at a higher rate, so therefore you must by definition be able to afford a mortgage at a lower rate if you move. It does not solve everything, but enabling people to move to a cheaper rate and switch to a repayment will help them to at least get to a point where perhaps they can then sell the property. I don't pretend to have all the answers, or indeed any. I am just a mere mortgage broker who wants to do my job well and help as many people as possible. But I know what we need is a clear will from government to help, a clear set of directives from them through the FCA to lenders to enable them to offer more products for mortgage prisoners that is not overly detrimental to the lenders themselves, that makes it easier for them. Without products or a set of workable criteria, brokers' hands will continue to be frustratingly tied, apart from the odd win here and there on a case-by-case basis. But this has to come from the very top. The reactions to the Super League in football were interesting, and the phrase "enough is enough" was used by all and sundry. If only the same passion, moral outrage and effort was used to tackle the cladding issues or to tackle the mortgage prisoner issue, then I'm sure we would get somewhere. But most importantly of all, in order to finally get to grips with this issue, we must both start and end with the same premise. These are people we are talking about, real people, real families, real issues. They are not and never should be considered mere assets.
Andrew, thank you very much indeed. That was a very, very well constructed set of thoughts. Let's show our appreciation to Andrew. Thank you very much indeed. Thank you.
Thank you.
Well said. Very, very well said. I think you're absolutely right. We need some creativity, some imagination. Where there's a will, there's a way. And the very low levels of creativity in finding the solution so far have been rather disappointing. We're going to go to Mark Bishop, and then we're going to be opening things up for a sort of general Q&A. For those of you that don't know TTF very well, you probably won't know Mark Bishop. Mark's a significant member of the TTF community, always full of very good ideas and insights. Mark Bishop, please, over to you. Thank you.
So the first thing I'd like to do is ask a question of Professor Collard. You put forward, I think, an excellent case for wanting to treat the mortgage prisoners as vulnerable customers, which triggers, a higher kind of level of interest and care on behalf of expectation on behalf of the industry and of the regulator. And you are on the FCA consumer panel, and as you're probably aware, the law, the 2012 Financial Services Act, sets out a relationship of kind of comply or explain between the FCA and its panels. I wonder whether the consumer panel is yet at the point of issuing the FCA with a formal letter requesting that it puts pressure on these lenders to treat these clients as vulnerable, and perhaps with a package of recommendations as to what that might mean. And if not, whether you will soon be at that point. So that's my question.
Let's hold it there, Mark. So let's deal with that first of all. Thank you. Very interesting question indeed. Sharon, your response, please, to the question that Mark just put to you. Thank you very much.
Yeah, thanks, Mark, for the question. The mortgage prisoners are a topic that the consumer panel regularly engages with the FCA on, and clearly with the newly announced review, that's something that we will be continuing to talk to them about. I think we haven't got to the point of writing a formal letter to them, but that's certainly something I will take back to my colleagues. I think it's certainly something that we've done on other topics. And as you say, we have got, we would expect to receive a reply on that. So I will actually, some of the ideas that have come up today that Rachel was talking about earlier about the kind of creative responses that are possible, I think I will certainly be taking those back to the consumer panel.
Thank you very much indeed. I should probably just mention that, again, if you check the 2012 Act, there is a requirement for the FCA to publish your representation and its response to it. So I think driving it out into the open, I think, might be quite useful. And secondly, Thanks, Mark, my just a minute, which I'll do now, is really a follow-on from what Andrew Montlake said I really like the fact that towards the end he was suggesting a pragmatic solution, and it's very much in that spirit that I'm offering you, the mortgage prisoners, an idea here. I stress that I'm not a lawyer, nor am I a kind of regulatory compliance expert, so there may be imperfections in this proposal, but equally sometimes people like me who look at this from an outside perspective spot things that those who are too close to it don't always see, so this may not be entirely wrong. In my experience, most mortgage contracts include portability clauses, which mean that you can move the loan in part or in entirety to a new property. Sometimes, of course, that falls away if you are in arrears or in other ways delinquent, but provided that you've kept your side of the bargain, the contract usually can be transferred to another property, just as the lender can transfer it via securitization to a third party. Now, of course, the problem with these contracts, once they've been sold, these loans have been sold to unauthorized firms, is that they cannot honor that clause. It is legally impossible for them to do so because they cannot issue a new loan on a new property. I wonder whether there might be merit in finding within the large number of mortgage prisoners, a person or a couple who borrowed, let's say, £250,000 some years ago. Kids have now left home. They now want to downsize. They'd quite like to keep a mortgage of £50,000 on a cheaper property. Ask them to apply for that loan via their existing lender. The lender will have to turn them down. It would be illegal to do otherwise. At that point, that lender is in breach of contract. At this stage, you now have got, I would hope and think, a compelling argument to try and rescind that contract. That contract, in fact, might have to be sold to a genuine ongoing lender that is authorised by the FCA to issue new residential mortgages, which is a regulated activity. Now, of course, nobody sane would want to port a mortgage at a usurious rate of interest. So I'm not suggesting that anybody would go through with it, but simply putting in the application would cost you nothing, and I think it would flush out the illogicality of the position. These loans should never have been sold because they contained portability clauses which the buyers were incapable of honouring. If this was successful, and I see that somebody here is, Paul King is giving me the thumbs up. If this was successful, I think what would have to happen is a sale to an ongoing lender. An ongoing lender might want to pay a discount because they're going to have to pay, they're going to have to charge you the SVR, but their SVR will be competitive because they are still issuing new mortgages.
Mark, thank you as always. You have tremendous insight and ideas and creativity, and you've just demonstrated that once again. I'm sure the folks at Mortgage Prisoners UK will want to evaluate that and explore whether it may have legs. And of course, Mark, we'll be very pleased to put you in contact with them if they'd like to pick your thoughts any further. Ladies and gentlemen, we've come to pretty much the end of the, if you like, the formal session, so to speak. Our speakers are all done. So what we're going to do now is kind of formally end the session. We'll carry on recording it. And I'm very happy to keep the channel open for another, who knows, 10, 15, 20 minutes, however long the conversation goes. I will facilitate the Q&A and the discussion, so we have a bit of structure and a bit of organisation. But let's try to open things up and see how we go. But of course, what we want to do now is thank all of our speakers. I personally have learned a lot from this. I hope others have as well. The single most important message is that all of the mortgage prisoners have battled for a long, long time. Sadly, the battle needs to continue. It's definitely not lost, and it's well worth continuing with the cause and the fight. People like Rachel and many colleagues at Mortgage Prisoners UK have been a shining example of grit and determination and tenacity and persistence and stubbornness. I no doubt driven by a fundamental belief that what's happened to them has been grotesquely unfair. So we salute you in what you've done. We want to support you in any way we can. Happy, Rachel, to fix up another event like this after the summer, maybe early September, whenever suits you and your colleagues. But the TTF is standing right beside you, right behind you. We want to do all we possibly can. So let's kind of thank all of our speakers and everybody that's been involved for participating, but then we'll go into the sort of the informal part of the session. But remember, we're going to carry on recording, so only say what you really want to say and mean to say, because we'll be putting the recording out on social media, etc. It's a very good way to try to get some traction. So thanks everybody that's participated thus far. If you have anything you'd like to say, please do so, but keep it brief. That way we get lots of chances for lots of people to say something. We have 5 screens worth of people on my laptop right now, so I can't see you all. So the best way to draw attention to yourself, if you want to, is to raise your hand digitally. But if you can't do that, just wave at me and I'll go to you. Hi Barry, nice to see you again. Please do make your point. Thank you, Barry.
Not at all. I just want to agree with and reinforce what was said about Rachel and Jill and the team, and that I'm glad that the word scandal has been attached to this now, and I'm sure it's going to stay attached. It should be attached. It is a scandal. It's of a very high magnitude as well. The harm to people is deep and wide, and I'm delighted that this event this evening has brought so much, attention and creativity to it. It's not the only scandal in the world. It's not the only scandal in the mortgage industry and the mortgage market. The fact that people can't get on the property ladder is pretty close to a scandal, if not already one. And that's a whole other area. But I'd also, as well as paying tribute rightly to Rachel and Jill and the team, I'd like to thank you, Andy, for getting behind this. I'm really pleased to see this, and I want to see what happens next.
Thank you, Barry. Thank you very much. Very kind thoughts. I'm going to check in with Rachel shortly, because it would be great to get Rachel's comments about the evening and any further thoughts she's had. But before we go to Rachel, we're going to go to Nicole. Nicole, thank you for raising your hand. Please feel free to introduce yourself and share your thought. Thank you.
Hi, I'm Nicole Renahan. I've written some of the reports for mortgage prisoners with Cara and with Anne, and we'd just really like to say thank you to Sharon for mentioning those reports. A lot of effort goes into them. It's emotional as much as sort of the time and physical, really. There's just an issue that's never really been discussed in any great deal, and that is around the sale to Cerberus. Whilst it was, or people involved with it were under criminal investigation by the National Crime Agency. That's still ongoing, I believe. I sort of try and keep on top of it, and the government at the time of the sale were aware of this investigation that was continuing, and in some sort of transcript that had come up in the parliamentary discussion stated that they had done their own internal investigation and come up with the fact that yes, these sales could proceed. And you sort of tie that in with the National Audit Office and Credit Suisse, who acted as advisor for sale and purchase, and it just all feels shall I say, as a criminologist on the sort of left loony side that Boris Johnson doesn't like, criminal and corrupt, and certainly in keeping with the current government, lacking transparency and saying whatever they want to say, because we don't expect much more. So I don't know, I just wondered whether anyone had any thoughts on that and why it just doesn't seem to have been picked up as a major issue.
Wow, I think you make a tremendous point, Nicole. Let's have any comments in response to that before we then go to our next person who's put his hand up, Nicholas Wilson. Would anybody like to reply or respond to what has just been said by Nicole? We've got a few hands have gone up there. Let's go to Ian Lightbody, then to Mark Bishop, then to Richard Seddon, and then we'll get to Nicholas Wilson. Ian, keep it short for me, please, if you could. Ian Lightbody.
Absolutely. Coming back in again, just the Cerberus aspect is a real smelly one. The fact is, George Osborne, for instance, who was Chancellor at the time, has been involved with various, very, very closely with these vulture funds and others. The relationship with basically these vulture funds, the Treasury and the judiciary as well, it needs exploding. Basically, somebody needs to get in amongst it. Cat, hello, Cat McShane, you need to do another number 2 and get in amongst this malfeasance. These guys, it's been going on too long, and all these wonderful people out here, these mortgage prisoners, they need to get their lives back very, very quickly. And to be honest with you, I could go on all night to be honest with Andy about this. The fact is, this was a deal that was done. It was to get damage limitation for governments. It was to get their cash back as quickly as possible. And it's just, innocent people have basically been used as a sort of funding tool for this malfeasance, and it needs to stop. And the quicker these people realise that, the better. So to keep strong and don't give up, and let's just keep at it. And Kat and Andy Verity, for instance, let's just get this exploded, and let's get a bomb under this thing, because it's not right.
Thank you very much indeed. Well said, sir. Very well said, sir. Let's go, please, to Richard Seddon. Richard.
Yeah, well, I keep posting on the mortgage prisoners. I mean, I live near Bradford and Bingley's old headquarters. You know, on the sign there, it says NRAM, and now it says Computershare, who own Heliodor, or Topaz, who own Heliodor, or whatever that mess is. But yeah, I keep saying there must be a route there for, the post office had a really top investigative journalist. Maybe Kat, that's you, I don't know. But, we don't seem to have that at the moment. And we need to get to the bones of this and expose all of these people who must have made loads of money. They must have done. You watch these films, oh, let's follow the money. Got to start following the money, because it will go back to government probably through these sharks and these vultures. And, maybe that is one of the routes, I don't know. But you go to the Bradford and Bingley headquarters, old headquarters, that's where NRAM are, and that's where Computershare are, who own Topaz, who own Heliodor, and probably Cerberus are in there as well, and Uncle Tom Cobley and all. Anyway.
Richard, thank you very much indeed. Great thoughts. Very well said. We're going to go to Mark Bishop, then to Nicholas Wilson. Mark, back to you.
Okay, thank you. I'd just like to address what Nicole said and talk a little bit about the politics of this. You mentioned you're looking at this from a kind of left-wing perspective. You and I on the left-right spectrum are on opposite sides. I'm Conservative, and some people might see me as being on the right of the Conservative Party, but personally I don't believe in the left-right spectrum. I don't think it really works anymore. I think there's an up-down spectrum, which is corporatism versus democracy, or what the enemies of it would call populism, and I think that's much more useful in understanding this. The problem that we have with mortgage prisoners was created by New Labour. New Labour wanted to generate huge reported profits from banks which it could tax very heavily. It wanted to borrow from banks, to back the projects that it believed in, and that worked for a while. When it stopped working, it left them with a mess. They didn't want two large banks and some small ones to fail catastrophically, so they did things to rescue them, which one might regard as immoral and perhaps even illegal. And that is really how the mortgage prisoner problem was created. I think that within politics on the left and the right, there are both corporatists and Democrats. And I think that this is very much true of the Conservative Party. There are many Conservatives who abhor the treatment of mortgage prisoners and desperately want to resolve that problem. And there are people like John Glenn. For example, when John Glenn announced the destruction of defeat of the mortgage prisoners amendment to the financial services bill that's now going through Parliament, I tweeted this out saying, John Glenn, you claim to be a Conservative. I'm a Conservative. I believe in Margaret Thatcher's vision of a property-owning democracy. Is this what you believe in? If you do, why are you behaving as you are? And I think that, as long as we have a democracy, corporatist politicians are very vulnerable to this kind of attack. And I think that, the same applies to small businesses. The number of SMEs that were destroyed during and particularly in the following years following the global financial crisis is shocking. And that happened under both political parties and the coalition. So corporatist politicians are available across the spectrum, and I think it is the job of us as the people to defeat them.
Thank you, Mark. Thank you very much indeed. We're going to go to Nicholas Wilson. Nicholas.
Thanks, Andy. Actually, I put my hand up to respond to Nicole's comments, and it just circles back to what I said right at the beginning. We've got to target the people involved. We've got to target the Richard Bankses. If we get convictions, then we don't have to mess around with all these group actions and arguing about fairness and so on. If we get people convicted of corruption, which is what has been going on, we will get recompense. We will get compensation. Why aren't we targeting the people? I mean, and it's corrupt. I mean, I'm not going to accuse Richard Banks of anything because I still need advice, but I think it's insider trading, insider dealing. He was the CEO of UKAR, and now he's a director of Heliodor. He had inside knowledge, as did John Glenn when he talked in Parliament and made up those figures about the rates of interest. He was at that time involved in negotiating, selling the final tranche. That is corruption of the highest order. He's told it Parliament. He lied about the interest rates in Parliament whilst he was negotiating the sale of the last tranche of mortgages. Get these people in prison, then we will get helped. I mean, we're all independent. We're not lawyers. We're people who have been victims of this. But as I said before, it's people that are doing this. It doesn't just happen. There are people behind this. We should be going after them. That's it. That's my final point.
Nicholas, thank you very much indeed. Let's now invite Rachel Neal and any of her other Mortgage Prisoners UK colleagues to share their thoughts before we start bringing the session to a close. Rachel, I hope the session has been in some way useful to you and your team. Your thoughts, please, Rachel. And of course, if you have any of your colleagues still with us that'd like to say a word, please, now's the time to do it. But let's go to Rachel first of all. Thank you, Rachel.
Thank you. And it has been far, more informative than what I could have ever wished for this evening, and I can only thank everybody that's come along and contributed to it. There are many different sides of the mortgage prisoner issue. There's the side of the corruption that we all know. There's the side of the heartbreak and homelessness that people are facing. There's the humanistic side, and it's the actual side of making changes. And the problem is that we're picking our battles. There's the legal side running along where we all feel wronged and we're all having to pay. We've all paid over the odds for years and years and years. And, all I can ask everybody to do is keep doing what you're doing, because we need the support. We need everybody to be as vocal as possible, and we need everybody to get behind everything that we're doing, because we are constantly looking into every single angle that everybody is discussing on here. We know how frustrating it is to sit there and watch John Glenn blatantly lie in court, he should be in court, in the Commons, about interest rates, about the amount of people that are affected. And we know probably deep down that he doesn't want to do anything. And I now believe that it's down to Rishi Sunak to do something. I think you have to go above John Glenn, because I don't think John Glenn will ever do anything. I think he's just there to keep kicking the can down the road. But all I can ask people to do is, I know how frustrating people feel when I ask them to write to their MPs and get involved, but the problem is that without the pressure and the understanding from MPs in Parliament, we just don't get anywhere. And the SVR cap, although it didn't go through, what did show up is the amount of MPs that actually stood up and said, this is now a huge problem and it needs resolving. And to have Martin Lewis state that this is his #1 campaign, we're making headway. We're making tracks, and everyone just needs to keep moving forward and keep shouting from the rooftops in a constructive way and look at every single angle. And that's all I can ask of people, really, for the campaign.
Rachel, thank you very much indeed. Thank you. I'm going to just share my screen and just draw your attention to the way the TTF works. So for those of you that were here at the beginning, you may have heard me mention that we have 25 different groups. One of our 25 groups is our debt group, and it's looking at 3 major issues: predatory lending, excuse me, predatory lending, buy now, pay later, mortgage prisoners. We'll put everybody that's attended tonight into our debt group. Of course, if you don't want to be in it, just let us know. Just reply to the email that you get to say don't want to be in it, and that's absolutely fine, of course. We have regular meetings for our various groups. So this particular group has a 45-minute catch-up on Monday, September the 6th, at 10 a.m. to 10:45 on Zoom. You're very welcome to join that quick catch-up conversation if you wish. But I will, if Rachel wants me to, put on another one of these meetings to bring everybody together, a full 2 hours, maybe a bit longer, to keep the momentum going. That's the trick now, building the pressure, keeping the momentum going, exactly as Rachel has just articulated. Okay, it's coming up to 8:30 UK time. We'll wrap it up there. Thank you all very, very much indeed for participating. I hope you found it useful. I hope you found it beneficial in some way. Let's work together. That's the key here. Let's share our knowledge. Let's share our ideas. Let's share our insights. Let's work together, and let's just keep pushing, because eventually something's going to crack in the defences, as it were, and then we'll start making some real progress. I salute you all. Thank you very much indeed.